Welcome to the Active Allocator Insight Series. We hope that educational presentations, such as this one, will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how Active Allocator can be a great way to help you figure out the cost and benefits of investing in illiquid assets. So, let's get started. Illiquidity is a risk factor, and it requires a return premium. Most of us prefer to hold liquid assets rather than illiquid ones. To entice us to hold illiquid assets, we demand either a return enhancement or a risk reduction. Establishing a target allocation to illiquid assets is quite challenging, however, for one cannot trade in and out of them at will. Maintaining a target allocation is even more challenging. After all, one must contend with uncertainty in investment valuations, as well as estimate the magnitude and timing of capital calls and future distributions. In alternative investments, illiquid and difficult-to-trade securities have unmeasured risk. Securities that are not consistently marked to market understate risk or volatility. Financial advisors use the Active Allocator portal to compare seemingly incomparable assets such as illiquid, non-traded investments in real estate, leveraged buyouts, and venture capital with liquid, publicly traded securities. But how attractive is illiquidity? That's what we solve for at Active Allocator. Well, it will depend in part on how each investor values liquidity. Investors will need to determine their own allocations to illiquid assets based on their tolerance for risks, cash flow requirements and time horizons, reinvestment opportunities, portfolio rebalancing frequency. Where it gets complicated, the illiquidity premium is driven by market conditions, and it keeps changing with exogenous market factor changes. We calculate a time-varying premium when we arrive at and optimize asset class weights. There are multiple sources of returns. These sources, including returns from illiquidity, are not directly observable, of course. The Active Allocator portal allows one to unbundle returns. We help you arrive at the most appropriate allocation to illiquids, arrived at in a rational, quantitative, rigorous manner. Our technology brings liquid and illiquid investments together. We make proprietary adjustments for serial correlation, stale valuations, and rebalancing costs in certain asset classes. We have developed unique algorithms for implementing different measures of risk associated with illiquidity. Our approach is based on accurately measuring the risk in illiquid asset classes, incorporating the limits to rebalancing one's portfolio, accounting for investor-specific liquidity requirements, and perhaps more importantly, forecasting the likely returns in asset classes that trade infrequently. Marking to market the returns in illiquid asset classes helps us compare illiquid assets' risks and correlations with traditional assets. Our approach takes historical reported data and modifies it with three kinds of information. First, to compensate for illiquid's stale pricing, we perform a process called unsmoothing. This process strips out the previous period's return from the current one and helps us to arrive at an independent and identically distributed returns series. We then mark-to-market illiquid asset classes to make them comparable to liquid asset classes. We also incorporate the cost of limitations on rebalancing, for these impose an implicit cost on portfolio optimization. We then help you arrive at personalized allocations to reflect individual requirements for liquidity. Illiquid asset classes suffer from a problem known as stale pricing. Investment managers employ a mixture of methods to report their returns. Many, for example, hold investments at book value until they are revalued in the marketplace through a sale. Even in cases when privately held assets are revalued, there are a wide range of methods for doing so, meaning that reported returns might or might not reflect the true value of the investment. As a second measure of this problem, the real correlation between reported returns in private equity markets with public markets are much higher than the valuations of private equity would lead one to believe. The effect of these two problems, understatement of risk and understatement of correlation, is that investors can over-allocate their investments to illiquid asset classes. Our calculations change the picture of risk and correlation to arrive at more appropriate allocations. Active Allocator recreates the data series, removes bias statistically, and makes return and risks in liquid and illiquid comparable. You will observe in these stylized charts, as we just talked about, that the real correlations and volatilities of privately held securities is much higher than what is observed. While there are indeed risks to investing in illiquid assets, appropriately accounting for risk and liquidity can help clients create portfolios which balance risk, return, and liquidity. Because it's harder to buy or sell illiquid assets, investors need to be paid a premium, net of the premium for illiquidity risk, to make them agree to lock up their money. This premium means we may have to reduce our expectations of return on illiquid investments by the amount we think we will be paid for taking the risk of holding illiquid assets. Active Allocator algorithms make a tradability premium adjustment in its algorithms. Investors in illiquid classes such as real estate may be locked up for years with no access to their principal. Since there are limited secondary markets, investors cannot dynamically rebalance their allocation if they fall short or exceed their target allocation. This means that they are clearly subject to costs that investors in traded assets do not have to bear. These costs are generally expressed in terms of loss of control over the portfolio's asset class exposures due to greater portfolio drift. Active Allocator calculates how far and for how long one is away from the theoretical efficient frontier to estimate such costs and arrives at optimized allocations. Active Allocator uses a quantitative discipline for measuring the risk in illiquid asset classes. In this stylized chart, we can see that higher allocations to illiquid assets generally create higher returns for the same amount of risk. The so-called liquidity premium cannot, of course, be determined in isolation. Its value will depend on the alternative investments available and the investor's willingness to make use of them. Our approach allows an advisor to tailor appropriate allocations of illiquid and liquid assets for clients' specific investment goals, risk profiles, and liquidity needs. To conclude, we suggest that the addition of illiquid and alternative alternatives can significantly enhance portfolio returns for given levels of risk. Investors without significant liquidity requirements should explore excess returns in illiquid assets. The liquid and illiquid parts of the portfolio cannot be separated. One needs to use liquid asset classes to effectively diversify risk in illiquid assets. Illiquid assets are both a risk reducer and return enhancer, suggesting larger than typical allocations in retail portfolios. We encourage you to take a test drive, build a few model portfolios, and see how Active Allocator might be useful for your clients. Thank you for listening in.